Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe and click the bell so that we can send you a notification when we release a new video. I'm sitting today again with Michael Porter. Good afternoon, Michael. We're actually filming in the afternoon.
Yeah, a bit warmer in here.
Yes, yeah. No scarves required. Hey. So, Michael, maybe a few things that have passed under the radar of investors. The Fed did meet and announced no change, and we also had inflation on our side. So, what is happening out there other than missiles going through the sky?
Yeah, well, that's the big thing that's happening, isn't it? There's lots of missiles going through the sky,
Yeah.
and I've seen a few pictures of sort of airspace over the Middle East. There's not a plane in sight. So you certainly wouldn't want to be taking your chances there at the moment with a commercial aeroplane. Anyway, sorry, back to a serious note. Yeah, the Fed met last night, Robin. They didn't cut interest rates, absolutely widely expected. I think it's really more around the discussion around the outlook and whether they're going to cut rates. So they still, their sort of dot plot, which they sort of forecast where rates are going to go, still sort of indicates 1 to 2 cuts for the remainder of this year, probably fewer cuts in the years thereafter, actually. So the markets, I think it was relatively benign. The market's kind of expecting it. The market's looking for clues as to where rates are going. You know, earlier in the day, Trump had called Jerome Powell, is it an idiot or a very silly person, or sorry, I can't remember the exact phrase, but something to that effect.
Not friendly.
No, not complimentary, put it that way.
Exactly.
So, yeah, and I think, the market's just a little bit anxious. I mean, obviously, the Fed still sees inflation going up a little bit from all the tariffs. The labor market is probably weakening a little bit, but not materially so. So they're kind of on hold for the moment, which is probably the right call,
Yes,
yeah.
yeah.
So yeah, that's the one thing. We had our own inflation, which came in at sort of 2.8%, very benign. Obviously, there is a concern around oil prices where they are, because they have been sort of $65, $67 a barrel for the last month or two, and now suddenly we're at $77 a barrel at the moment, given what's happening in Israel and Iran, and whether that's going to. I mean, everybody's on tenterhooks wondering whether the US joins the fight or not.
Yeah.
And Trump doesn't help things. I might not. Who knows what I'm going to do? It's like, I'm not sure that's the language of the most powerful president on the planet in terms of portraying some sort of thought process and what's going on. I'm not saying that there isn't a thought process, but it's not helpful when he's kind of like acting like he's sort of in the playground. Or what am I going to do? Who knows?
Well,
so anyway,
especially not if you're an Iranian leader. Yeah.
So I mean, I think the markets are really just on tenterhooks around that, and I suppose the concern from a market point of view is if the US does get involved, what does that do to oil prices? What does that do to possible retaliations, or whatever the case is? And does that take the conflict to a whole nother level? Because I mean, if you look back in history, actually, the oil price reaction around sort of Israeli wars and aggression has actually been relatively muted. So I suppose, everybody's just waiting to see what happens next, and is this a short war? Is this going to drag on for months until there's nothing left of Iran if Israel gets its way? So uncertain, Robin. I mean, without very quickly. I mean, I think it really just comes back to what we were talking about at Insight. There's so much uncertainty. The headlines are just changing all the time. And so, again, it's just a time to sort of stick to your knitting and, have quality shares in the portfolio rather than not. Because, I mean, every day we could probably talk about a different headline and it just veers off, doesn't it?
Yeah, absolutely. Michael, I mean, I think it's a great opportunity to remind investors that we've been through something similar. I remember when when the Russia invaded Ukraine and we had all that, and there was all that sort of thing in the market, and really that's now page 3, 4, 5, isn't it? And yet that conflict still continues. But the market has kind of balanced that out in the equation. I mean, it'll do much the same with us, won't it?
Yeah, it will, Robin. I mean, I think the market sort of gets used to it. It sort of prices a scenario in, and it goes forward. I mean, you do have to love the hypocrisy of Russia, saying, this strike and war was illegal and urging restraint from Israel and both sides. It's like, really, do they not read the same papers we read?
Well, they're politicians, Michael. We have to remember that.
Okay.
So, I mean, I think probably that's a good segue into always bringing it back down to what is really most important is what's happening on the ground. Companies are not countries, something, that's a mantra that we've held and probably said many, many times. But nice to bring it back into a space that's very, very important to us, which is the property space. Local property and even sort of the European property surprising nicely to the upside at the moment.
Yeah, Robin, we've had a couple of results from some of our bigger holdings, Spear, Vukile, Storage, and our results are strong, So, I mean, Spear and Vukile had very good results, well-managed funds, growing. Share prices have reacted quite positively in the last, I suppose, year. So you're finding that companies are now having the opportunity to raise capital at a better price, and interest rates are coming down a little bit, so that takes off the pressure off the debt line. But they can raise a bit of capital, they can do accretive deals, they can invest that capital at a higher yield than what they have to pay for it, which is sort of the economic value add concept we talked about at our Insight presentation. And so you're sort of getting that. You're not just getting the growth from the rental escalations, which are also turning more positive, and especially on the retail side in this country and the industrial side, the rents are growing again, which is really nice to see after quite a long time of flat or declining rentals. But so you're getting that organic growth where rentals are rising, vacancies are dropping, and you're getting that kind of growth coming through. But you're also then finding that there's opportunity for these companies to go out and do deals and raise capital and grow their portfolios in an accretive manner, So Vukile's been really successful in Spain. They've really pioneered the Spanish and Portuguese market and done very well out of it. Spear has long been a favorite, focused on the Western Cape. Storage, I mean, they've also just rebased their dividend to a 90% payout ratio, which is why the dividend was slightly lower, even though the earnings grew. But yeah, Robin, I think, property is really getting back to that, distribution growth again, which then underpins the yield. So yes, the share prices have rallied and probably do a little bit of consolidation now. But when you get that distribution coming through, then it supports the share prices and underpins them,
Which is great.
Especially relative to bonds and things like that. So it's really nice to see. It's been quite a long time coming. But if you actually just listen to the management teams, there's a spring in the step, which is also nice. There's activity going on. You kind of feel that they're energized and not just on the back foot, which is good to see, because then they're out looking for opportunity.
Nice to be in a position where South Africa seems to be a nicer place to be than other parts of the world, isn't it? So it doesn't always run that way. Thank you so much for joining us, Michael. Thank you for your insights. Please don't forget to like and subscribe, and we will catch you next time. Bye-bye.